Hello, Assalamu alaikum. I hope everybody is able to hear me. Can you people hear me? Okay, great. This is Ijaz Khan, and as you all know, I'll be your instructor for the rest of the 4 days. Before we can actually start, let me first share with you what these 4 days will be all about. As you all know that the name of these sessions um, is practice to pass. So accordingly, the focus on the focus will be on uh, practicing more and more questions, so that you people become familiar with what you are going to face in your exams. But because of the dynamics of this financial management paper, before we can actually move towards practicing the questions, uh, in our today's session specifically, I will be focusing on few basic concepts. And the basic concepts that we are going to study today will actually be the base of the whole financial management. So I don't want to skip those basics, uh, because I feel that if I don't go through those basics, maybe we will find difficulties in solving the questions. So in today's session, we won't be practicing that much on exam length questions. The focus of today's session will be on the basics of financial management, especially the basics of investment appraisal. Before we start the basics, let me first discuss the paper format for your computer-based exam. Uh, as your other foundation level papers, the financial management's paper will have 3 sections, one of which will be section A, which will have 15 multiple choice questions or objective type questions with 2 marks each and 30 marks in total. Then you will have section B, which will have 3 OT type question scenarios, case studies, and each case study will be split into 5 objective type questions. Again, each question will be of 2 marks, so there will be a total of 15 objective type questions from these 3 scenarios, and the total marks here will also be 30. So it means that the total paper will have objective type questions equal to 60 marks. So it's very important to have a grip on objective type questions, and as the course will progress, we will learn some techniques of how to gain maximum marks in these 2 sections. And then there will be section C, which will have 20 marks descriptive questions, which are called constructed response questions. Each of them will have 20 marks, and these 2 questions will actually be attempted either by way of using spreadsheets, or you will have a word processing workspace given in the exam in which you have to type your responses. So there will be a total of 40 marks in this sections available. So as any other paper, here you will have to score at least 50% to pass this exam. Now, as per the syllabus and the exam guidance provided by ACCA. These two 20-mark questions will be from either of these following sections, syllabus sections, that is working capital management, investment appraisal, and business finance areas. So this is the syllabus. 7 areas in total. Financial management function. From this area, you will only be tested in your section A and section B of the paper, which is the objective type questions. Same goes for the financial management environment. The questions from this area will only be tested in the form of objective type questions. Then you have working capital management. It can be tested in either format, in either of the 3 formats. Investment appraisal, again, same as working capital. It will be tested in both section A, B, and C. Sources of finance, same. You will see objective type questions. You will see constructed response questions from this area as well. Business valuation and cost of capital. This area will mainly be tested in your section A and B of the paper. And then the risk management, which will also be tested in the form of objective type questions. So as I told you that we'll be starting with the very basics of investment appraisal and very basics of financial management, so that when we'll go to full exam length questions, we won't be having any problem solving those questions, and we'll be solving those questions mainly on spreadsheet platform, so that you people become familiar with how you are going to solve those questions in your exams. So before I can start, I just want anyone, if anyone of you has any questions, you people may ask before we can actually start. If there are any questions from your side, you people can use the chat box. Okay, I hope there are no questions. So let's start. I will start from the very basic, which is the compound interest calculation. Though it will be very basic, but you have to bear with me, because this is the very basic of financial management, and once this area is clear in your minds, it will be too easy to understand the full exam length questions. So let's start. Well, let's suppose that Mr. A is considering to invest an amount equal to $10,000 today. And when we say today in financial management, we denote this time by 0. So the 0 represents today. That is something invested immediately. So at point 0, Mr. A is considering to invest $10,000 in a 2 years project at 10% per annum. It means that every year Mr. A is going to receive 10% of the amount invested. So after 1 year, the total amount will be $10,000 plus 10% return. The 10% return will be equal to $1,000. So the total that Mr. A will have after the end of the first year will be $11,000. If he keeps this amount invested for the next year as well, he will get again 10%, but this time this 10% will be of 11,000 since it's a compound interest. So in case of a compound interest, every year the interest will be compounded. So it will be 10% of 11,000, which will be equal to 1,100. So after the end of the second year, his total value of investment will reach to $12,100. Now, the amount invested initially will be denoted by P, which can be called as principal, or we can also call it as present value. The amount that Mr. A is going to receive after the end of the project will be called sum, or we can also call it future value, and we can denote it by S. The rate of interest will be denoted by R, and the number of periods will be denoted by N. So if we want to create a relationship between P and S, it will be, the S will be equal to your principal and the amount of interest earned during the project's life. So whenever we are supposed to calculate the sum, it will mean that we have to include interest into the principal to get the sum. But whenever we are supposed to calculate principal or present value, we have to offload the amount of interest. So the difference between the principal present value and the sum is the amount of interest. So the sum or the future value will always include the amount of interest, whereas the principal or P will exclude the amount of interest. So if you look at this relationship, which is $10,000, if we add 10% of the $10,000 into these $10,000, we'll get the sum after year one. So how can we add this 10%? Simply, if we multiply this 10,000 by 1.1, we'll get 11,000. And if we multiply it with 1.1 again, we'll get 12,100. That is the sum after 2 years. So it means that we can multiply 10,000 by 1.1 raised to the power 2 because we have to find out the sum after the end of year 2. Since the number of periods is 2, we have placed 2 here, but not in every case because the projects will have different lives. So this will be a variable denoted by N. So the rate of interest will change in the question. Therefore, it won't be 1.1 every time. So let's denote these values by variables, as we have denoted the principal by P. The rate of interest will be denoted by R. So it will always be equal to 1 plus R. And for number of years, we'll just place N as a power. In this case, we'll be able to find S. So in case of a compound interest relationship, the sum will be calculated using this summarized formula. S is equal to P into 1 plus R raised to the power N. So here is the formula, in which N is the number of years or periods, R is the rate of interest, P is the principal or present value, and S is the sum or future value. So the key point here is that whenever we are supposed to calculate the principal, we have to actually offload the amount of interest. But whenever we are supposed to calculate the sum, we have to include the amount of interest. So look at this example. Mr. A invests a sum of $1,000 for 2 years at a compound interest rate of 10% per year. What will be the total value of his investment after 2 years? Now, when this is being asked that find out the total value of investment, it means you need to find out the principal plus interest, that is sum. So S is equal to P into 1 plus R raised to the power N will give us the total value of investment. So you will have 30 seconds to solve this question. Just quickly solve this question and come up with the answer. Okay, we'll put 1,000 as our principal. The rate of interest will be 10%, which we'll put as 0.1. And since we need to find out the sum after 2 years, so we'll put 2 as our power. And the resulting answer will be $1,210. So from the same information, if we need to offload the interest, that is, if we need to find out the principal, now we'll use 1210 as our sum. And we'll be putting P as our principal, 0.1 raised to the power 2. So if we solve it for P, we'll again get the $1,000 that was invested at 0.0. So the difference between these two values is actually the amount of interest earned during 2 years. So from now onwards, I expect all of you to know the difference between P and S. The present value means we have offloaded the interest, and the future value means we are including the amount of interest. So we can just rearrange this formula for calculating P directly. So it will be is equal to P is equal to S divided by 1 plus R raised to the power N, or it can be P is equal to S into 1 plus R raised to the power minus N. So we can use this formula as well for calculating the value of P, that is the present value. So go ahead and solve these two examples. You people should not take more than 2 minutes for solving these two questions. May I know the answer for the first example? Oh, great. Company is considering to invest X dollars at 10% per year for 3 years. After 3 years, it is expected to receive a total of 10648, which is the sum. This is P, this is R, and this is N. So what we need to find out is the value of X, which is P. So P will be equal to S 10648 into 1 plus 0.1 raised to the power minus 3. So it's $8,000. Okay, great. May I know the answer for example 2? Uzair and Sakina has come up with the answer. Hiba, I'm afraid that your answer is not correct. So here we need to find out the value of X, but this time the X is the rate of interest at which the amount is invested. So a company is considering to invest, it's $15,000 investment. So P $15,000. Sum is 19662. We need to find out the rate of interest. And since it's a 4 years project, so we'll just put 4 here. So is it 7%? Is it 7%? Okay, all you have to do is to divide this figure here. And if you do so, you will get 1.3108 is equal to 1 plus r raised to the power 4. So to remove the power from here, we need to put a power as 1 upon 4 on the other side. So it will be 1 plus r is equal to 1.3108 raised to the power 1 upon 4. So if we solve it, are we going to get 7%? So I don't have a scientific calculator at the moment with me, so I'm sure the answer to this question will be 7%. It's 7%, right? So I hope it's clear. It's 7% approximately. Should we move forward? Okay, just forget about effective rate. Let's jump to the net present value. Now, now one of the key syllabus areas of financial management is investment appraisal. Investment appraisal is actually appraising a project before it could actually be accepted. A company's management may have 2 or 3 options, or one option, or more than one option to select from it. Before the company decides to go for a particular project, it must evaluate, appraise a project. And if it finds the project feasible, if it finds the project attractive from both from financial and non-financial perspectives, only then the company will accept a particular project. So we're not discussing the non-financial aspect at the moment. We'll be discussing the financial aspect of accepting a project. So if you want to accept any particular project, you must evaluate from financial point of view first before you can actually go for it. So there are different ways which can be used to evaluate a project, and one of those ways is the net present value. So before we move forward and go deep into what net present value is, let's first start with a very basic example to see what net present value is. Suppose that Mr. A is considering to invest an amount in a project, and the amount to be invested is $10,000. Now, let's say it's a 1-year project, and after 1 year, Mr. A will receive a total of $12,000. The amount to be invested in this project is a cash outflow for Mr. A. And the amount that he will be receiving after 1 year or after the end of the project is cash inflow. Now, apparently, it seems a very good project, as $10,000 are required to be invested today, and $12,000 will be received in a year's time. So apparently it seems an attractive project, but this is not a straightforward decision, because the amount to be invested is required to be invested at 0.0, and what Mr. A is going to receive will be in a year's time. So there is a 1 year difference between the cash outflow and the cash inflow. And if we look at from Mr. A's perspective, or let's take it from a company's perspective, the company is required to invest $10,000, but as you know, that every company is considered as a separate legal entity from its investors. So these $10,000 will be generated by the company either through equity, that is raising shares, share capital, or borrowing from a bank. So from whoever this company takes these $10,000 will certainly require a return on investment. So the company has to make sure that it earns or generates enough returns to satisfy its investors. Let's say the investors require 10% per annum return against their investments. So the company has to make sure that it earns at least 10% from the investment. Now, just for the time being, ignore the amount of investment required for this project. And let's find out what maximum should the company invest for these $12,000. As you know, the minimum that the company would like to have is to recover the initial investment and the 10% return on investment. This is the minimum that a company would like to generate from a particular project. At the moment, this company is going to get $12,000 at the end of year one. So if we assume that the company is going to invest X dollars for these $12,000, so the company will have to make sure that whatever cash inflow it generates should at least recover the amount invested plus the 10% return on that amount. So this company would like $12,000 to be equal to the amount invested and 10% of this amount invested. So company would like 12,000 to be sum of these two. So if you try to find out from the help of this equation what maximum amount should this company invest against these $12,000 to ensure that it recovers its investment and the return on investment. So can you people just solve this equation to find out the value of X for me? I want everyone to come up with the answer. Thank you, Mariam. Yes, it's the correct answer, and I want everybody else to solve the equation for X. Just two answers. Great. Yeah, it's 10909. What does this mean? This means that this company needs to invest a maximum of 10909 if it really wants to recover its amount invested and 10% of the amount invested. So if it invests 10909 today, after year one, when it will have to return the amount invested to the investors and the 10% return. So if you just take 10% of 10909, it will be 1091. So to satisfy the investors, this company needs to generate 10909 and 1091 after the end of the project. If we sum these two cash flows, it will give us a total of $12,000, and it is exactly what is being generated from this project, $12,000. So what this example is telling us that this company should not invest more than $10909 for these $12,000. it should invest a maximum of $10,909. Now this figure will be compared with the actual investment required in this project. The actual investment required for this project is $10,000, whereas the maximum that this company can afford to invest for this project is $10,909. So my question to all of you is, should the company go for this project? Well, let me repeat. According to what we have solved, the maximum amount required to be invested for this project is 10,909. Because if this company invests 10,909 today and its investors require a return of 10%, that is 10% of 10,909, which is equal to 1091. So after year one, it will have to pay back its investors an amount equal to 10,909 if it invests this amount today. And in years time, it will also have to pay 10% of this investment, which is 1091, to its investors. So it means it will have to pay back a total of $12,000 to its investors, which includes the investment and the return on investment. So it will be $12,000, and this is exactly what will be generated from this project. Now, according to the example, the actual required investment is $10,000, whereas the maximum that this company can afford to invest is 10,909. Even if the company invests 10,909, it won't be at loss. It will be exactly able to recover its investment and return on investment. But the required investment is just $10,000, which is $909 less than the maximum to be invested. Since this company is going to save $909 if it invests $10,000 today, therefore, this company should go for this investment. Is it clear? Okay, let me explain it again. We just calculated this figure. That is the amount that this company should invest. It was 10,909. Investing 10,909 for $12,000 means if this company invests $10,909 today, if it invests $10,909 today, after 1 year, it will have to pay back this amount to its investors, plus the 10% of this amount to its investors, which will be $1,091. It means that the company needs $12,000, that is the sum of these two, to recover the investment and the return on investment. And $12,000 is what actually it is going to receive from this project. So it means that even if this company invests $10,909 in this project, it won't be at loss. Is that clear? If this company invests 10,909 today and receives $12,000 after year one, it won't be at loss. So the company will have made up its mind that it is going to invest up to $10,909. Now, since the required investment is just $10,000, which is less than 10,909, which the company is ready to invest, So the company, after investing $10,000, will actually save $909. Therefore, the company will be going for this type of project. Is it clear now? Okay, great. Now, what these $10909 tell us? $10909. How we can calculate in any other way? It's actually the present value, because it's the amount that the company needs to invest. So it's a present value, that is the amount without interest. So we can calculate this figure by the formula that we just read a few slides back. 1 plus r raised to the power minus n. So for S, we will just put 12,000. For R, we'll just put 0.1. And since we need to find out the present value for a cash flow that is going to be received in 1 year's time, the power will be minus 1. So can you just solve it again and tell me what will be the value of P? Okay, it's again 10909. Yeah. So since $12,000 were cash inflows, we can say that 10909 is actually the present value of cash inflow. So the present value of cash inflow is actually the maximum amount that a company should invest in a particular project. It's the maximum that a company should invest in a project. Remember this. Now, once we have calculated the present value of cash inflow, we will then compare it with the amount required for the investment, which is the present value of cash outflow. So the present value of cash inflow in this example was 10909, whereas the required investment, which is the present value of cash outflow, was equal to $10,000. And since the present value of cash inflow was higher than the actual required investment, the company was saving $909. Since this amount 909 is the net of two present values, therefore we call it net present value. And whenever we find this net present value positive, we should accept the project, as it tells us that the required investment is lower than the maximum that a company should invest. So the positive net present value suggests that if the company accepts this project, it will gain from accepting the project. Is it clear? So this is the basic concept of net present value. So from now onwards, do remember one thing. Whenever we will be calculating present value of a particular cash inflow, it will tell us the maximum amount that a company should invest for a project. So let's move forward to the next slide. And in this example, it's actually the same example. So let's move towards the next one. A company is considering to invest $12,000 in 1 year's project, after the end of which it is expecting to receive a total of $13,000. If the cost of the company is 10%, Based on the NPV, suggest whether the company should undertake this project or not. Just go ahead and calculate the net present value of this project. First of all, we need to calculate the present value of the cash inflows. So the amount that the company is going to receive, which is $13,000. So we need to find out the present value for $13,000. 1.1 raised to the power minus 1. May I know what is the present value of $13,000? Okay, 11818. So this is the maximum that should be invested for these cash flows if the company really wants to generate a 10% return from this project. But if the company invests more than this amount, it will be at loss. If it invests less than this amount, it will be at gain. So now let's compare with the actual required investment. And remember, the company should not be investing more than $11,818. So the required investment is $12,000, which is above 11,818, and the difference is $182. Since the required investment is higher than what should be invested, therefore the company should not invest in this project. Is it clear? Let's move forward. Just solve this question. Okay, I just want all of you to solve the next two questions, example 2 and example 3 for me. And just give me 5 minutes. I'll be back in 5 minutes. Meanwhile, you people solve these two questions. Is that okay? Okay, just solve example 2 and 3. I'll be back in 5 minutes. Hi, I'm back. So the amount to be received in 3 years' time is $22,000. The rate of return required is 8%, so we'll just put 1.08. And since it's a 3 years project, so we'll put -3. So what's the present value of $22,000? $17464. 464, okay. So this is what should be invested at max for this project, whereas the required investment is less than this, and it will give a positive NPV of 2464. Therefore, it should be accepted on financial ground. So let's move towards the next example, example 3. And the difference between this example and the previous example is that in previous example, the company was going to receive $22,000 at the end of the third year, and nothing was supposed to be received in year 1 and year 2. But in this example, this project is generating cash inflows after the end of every single year for 3 years. So since the cash flows are generated uh, in every year, so the present value for each cash inflow will be calculated separately as the years are different. So first of all, we will be calculating the present value of $10,000 that will be received after the end of year 1. The rate of interest is 10%. So 10,000 into 1.1 raised to the power -1. May I know the present value? Then we'll be solving 11,000 into 1.1 raised to the power -2. Then we'll have $12,000 into 1.1 raised to the power -3. So for the first cash flow, it's $9090. May I know for the year 2? So for year 2, it's approximately the same, 9090. And for year 3, it's 9015 or $16. Okay, 9090, 9090, and 9015. So now we need to sum all these cash present values to see what's the total amount that should be invested for this project. 27195. So the maximum that this company should invest for this project is 27195, whereas the required investment is just $25,000, which is lower than the maximum that should be invested. So it's 2195 approximately positive. Therefore, on financial grounds, it should be accepted. Iram, we will be using the NPV table values. So I hope this example is clear to everyone. Yeah, Iram, I'm not using at the moment because I haven't taught what those table values are. So in a while, I'll be just sharing. Now, okay, as you all know, we calculated the present value of 9090 by multiplying 10,000 with 1.1 raised to the power minus 1. See, if instead of calculating the present value of $10,000, if we were to calculate the present value of $1 instead of $10,000, that is, if I ask you how much should be invested, how much should be invested for a $1 which will be received in a year's time, how much maximum should be invested today for a $1 to be received in 1 year's time? In that case, we'll write $1 instead of 10,000, 1.1 raised to the power minus 1. So may I know the value? Yeah, 0.909. 0.909. What does this tell us? This $0.909 means that if a company wants to generate a return of 10%, it should invest $0.909 today against $1 to be received in 1 year's time. The maximum that should be invested for $1 to be received in 1 year's time should be 0.909, provided that the company needs to generate a return of 10%. So for every $1 that it receives in 1 year's time, it should invest $0.909. This value, which is the present value of $1, is called discount factor. Discount factor is actually the present value of $1. Now it will make things very simple. If we know what's the present value of $1, it will be very easy for us to find out the value of any number of dollars if we know the present value of $1. All we have to do is to multiply with the cash flow to get the present value. Like in this example, as I told you that for every $1 to be received in 1 year's time, we need to invest $0.909 today if we need to generate a 10% return. So for every $1, it should be 0.909. Then how much should be invested for $10,000, which will be received in 1 year's time? We just need to multiply it. So if we multiply 10,000 by 0.909, which is the discount factor, we will get the present value 9090. So for year one, this is what the present value of $1 will be. Now let's see what should be invested for $1 that will be received in 2 years' time. If I ask you what should be invested today for $1 that will be received in 2 years' time from now. So again, we'll write 1 here. The rate of interest is the same, 10%, but the power in this case will be minus 2, as this $1 will be received in 2 years' time. So definitely we will be investing less than the previous value, because this amount will be now received in 2 years' time. So the company will be investing 0.826 today, so that when it receives $1 after 2 years, it will be able to generate its 10% per annum return. So for every $1 to be received in 2 years' time, the company is going to be investing 0.826. So if this is for $1, then what should be invested for the total $11,000? We just need to multiply. Simple. we'll get the same present value. In the same way, if we need to calculate the present value of $1 to be received in 3 years' time from now, what will be the answer? May I know the present value of $1 to be received in 3 years' time? 0.751. So for third year, the discount factor should be 0.751. Now, if we multiply 12,000 by 0.751, it will approximately give me the same value as 9015. So it would be too convenient for us if we know these discount factors in advance. All we need to pick the relevant discount factors and then multiply it with the cash flows to get the present values. So in the exams, you people will be given a table called present value table, and it will be in this form as on your screens. So what we need to do is to pick the relevant column, which will depend on the discount rate that we are using, and it will depend on the value of n. Like in our example, it was 10%. So for year 1, it was 0.909. For year 2, it was 0.826. And for year 3, it was 0.751. Remember, the whole table shows present values of $1 at different rate and different timing. So we need to pick up the relevant discount factors from this table and just put it in our example and find out the present values. Mariam, haven't you people downloaded and taken the printout of these this PowerPoint presentation? You people were supposed to download and take the hard copy printout of these questions, and so that you could easily note it down whatever I'm writing. So let's move forward and solve another question. And this time you need to solve this question using discount factors. Remember, the discount factor column should be for 10%, and it should be for year 1, year 2, and year 3. So what discount factor should I write for year 1? 0.909, right? 0.826 and 0.751. So these values will just be copied from the discount factor table, and we just need to multiply these two values to get the present value. So what will be the present value of 15,000? $13635. Great. And then for 20,000? $16520, right? And for the next? 18775. So let's just add all these values. 48930. Then 3930, right? Okay, let's move forward to the fifth example. In the fifth example, I have already put the discount factors at the rate of 8%. So you people need to multiply the figures and tell me the present values. 23150. Okay. What's next? 21425. 21425. And what's next? 19850. And what's the total? Total of these three. Oh, quick enough. Which of the two is correct? Okay, 64425. 64425. So it means it's a $4425 positive NPV. Okay, now I want everybody to listen and watch very carefully. If you just note that we are receiving same cash flows after the end of every year. When we receive same amount every year, this is an annuity project. This same amount received every year is called annuity. So annuity is a constant amount received after regular intervals. So it's an annuity project. Now, if you look at this value, this has been calculated by taking the sum of the products of these values. Now, if I take 25,000 as a common value, and I sum all these three values, that is the discount factors, may I have the sum of these three discount factors? $2.577. Okay. The sum of discount factors is called annuity factor, or you may call it cumulative discount factor. This 2.577 is actually the sum of the first 3 years discount factors. So instead of multiplying the individual values with 25,000, if you just multiply this annuity factor, which is 2.577, with the amount of annuity, we'll get the present value directly. 64425. So if we know the annuity factor, all we have to do is to multiply this factor with the annuity. We'll get the present value of all cash inflows. And then later we will deduct the initial investment to get the net present value. Now, from where we are going to get this 2.577? We have a formula for calculating annuity factor, which is 1 minus 1 plus r raised to the power minus n divided by r. So we can use this formula for calculating annuity factor. This is one way of getting this annuity factor. The other way of getting the same annuity factor is using the annuity table. Like the discount factor table, we have a table which shows the sum of the discount factors called annuity factor table. So if we go back to those two tables, if you look at this table, none of these values is more than 1. All these values are less than 1 because these are simple discount factors. But if you look at the next table, you can see all the values in the first row are less than 1 because it is just for 1 year. But in the second row, the values are more than 1 because these values show the sum of discount factors. So in our case, the discount rate was 8%. So we'll just go to the 8% column, and since we needed the sum of first 3 years, we'll directly go to the third row of the same column, and we can see the discount annuity factor, which is 2.577. But remember, at any point, say for example, if we go to 5th year, the 5th year value is actually the sum of discount factor from year 1 to year 5. If we go to the 6th row, this is the sum of the discount factors from year 1 to 6. So all these values start from year 1. So these show the sum of discount factors starting from year 1. So we just need to pick the annuity factor from this table. Make sure you are looking at the annuity factor table and not the discount factor table, and make sure that you know the difference between the two. Discount factor table shows present values of $1 only at any particular point of time, whereas the annuity factor table shows the sum of the discount factors for any number of years. So we can pick up the discount annuity factor from that table and multiply it with the annuity to get the present value. So let's move forward. Just go ahead and solve this question for me. Remember, the difference between this question and the previous example is that it starts from year 0. So you just forget this amount. Just forget this amount for the time being. And you just solve it in a normal way, assuming that it starts from year 1 and ends at year 3. Can you people just tell me the annuity factor? Remember, we are just ignoring this first cash flow. We're just ignoring this for the time being. So may I know the may I know the annuity factor? Since we are ignoring the first cash inflow, so it's just a normal project starting from year 1 and ending at year 3 end. So it would be 2.577. Now, if I just multiply this 2.577 with 15,000, it will give me the present value of cash flows starting from year 1 to the end of year 3. But in this project, it is clearly mentioned that the project is expected to generate cash inflows of $15,000 per year, with first one due now. So it's a 4 years project with the first cash flow to be received immediately. That is at point 0. So 0, 1, 2, 3. But if we just multiply it with 2.577, we'll just get the present value from year 1 to year 3, which will not be the correct answer. So what we need to do is We'll just pick the discount NVT factor from year 1 to year 3 from the table, as the table will always show the NVT factor from year 1 onwards. So it's 2.577. And remember one thing, any cash flow which is received or paid immediately at point 0 will have a discount factor equal to 1. It will always have a discount factor equal to 1. So we'll just add 1 for this point 0 cash inflow. So whenever we are supposed to receive a cash inflow immediately, we'll just add 1 to our NVT factor. So it will be 3.577 multiplied with 15,000. May I know the answer? $53655. Now this is the present value of cash inflows from year 0 to year 3. Now it includes the present value of all four cash inflows. Then we need to subtract 40,000 to get the net present value. $13655. But we can also solve this question using this tabular approach. But definitely it will take time. We have to calculate present value of every cash flow separately and then add. But if we do so, we'll get the same answer as we've done so. Is it clear? Okay, let me give you an alternative way of solving the same question. And it will also give you the same answer. Just look at the formula above. Present value of advance annuity. Just write down the annuity, which is 15,000. Multiply it with the annuity factor. Forget about the advance thing. Just focus on the project life. It's a 4-year project. So just pick the 4 years annuity factor and just forget that you are receiving something in advance. So a 4-year project, therefore we should take a 4-year annuity factor. So may I know the 4 years annuity factor? 3.312. Okay, if it was an ordinary annuity of a 4-year project, that is starting from year 1 to year 4, we call it an ordinary annuity, we wouldn't be required to do anything else. So we just had to multiply 15,000 by 3.312 to get the present value. But since it's an advance annuity, we have to multiply it with 1 plus R. So just multiply it with 1 plus R. R is 8%, so we just need to write as 0.08. So 15,000 into 3.312, that is the 4 years annuity factor, and then multiply it with 1.08 to adjust the impact of advance annuity. May I know the answer? So it's approximately the same, 53654. Shoaib, you just need to recalculate the figure. It's not 78,000. So it's 53655 or 54, approximately the same, minus 40,000, and it will be 13654. So we've got 3 ways of calculating the same. One is the tabular approach. The other is just picking up 3 years annuity factor and add 1 and multiply it with 15,000. And in the second example, in the third approach, you just need to write the annuity figure, 15,000, pick up the annuity factor for the project life, that is 4 years, and then multiply it with 1 plus R, that is the discount rate. Ali, 3.312 is the annuity factor for 4 years project. If you just look at the annuity factor table, I hope you have the NVT factor table. Go to the 8% column. Go to the 8% column and look at the fourth row. Can't we keep it simple? Just ask it. Well, there are three different approaches, Saad. It's up to you which approach you feel is simple. You can use it. I have told you all three approaches, and it's totally up to the student which approach he or she uses. So why did you cut and change the year? Okay, actually it was a mistake, Nakib. It was a mistake. It's a 4-year project because there are 4 cash flows involved. And we can't have 4 cash inflows in a 3 years project. Usually you will get profit every year. So if there are 4 cash inflows involved, it means that it's a 4 years project. So it was a misprint, a typo, which I corrected. So okay, just quickly, let me just make few changes to the question, and I want you people to solve this question for me. A company is considering to invest $32,000 in a 5 years project, and the project is expected to generate $11,000 per year, with first one due now. If the cost of capital is 10%, calculate the NPV of the project. So I've made few changes to the question. Just quickly solve the question for me. And it's totally up to you people which approach you people use. I would suggest to stick to one approach so that you don't get confused in the exams. Wow, too many variations. We have already got 3 different net present values. I just loved the creativity of you people. You're coming up with very creative answers, and it's good. Looking at your creativity, I believe you people will be ending up working with in high-tech companies. Okay. Okay. So let's use this project, this approach. The annuity is $11,000 every year. The annuity factor should be equal to the project's life, which is 5 years. So we just need to pick annuity factor at 10% for 5 years. So just let's go back to the table and see what annuity factor do we have for the 5th year. 10%, and it's 3.791. 3.791. Remember, 3.791 is calculated on the assumption that the first cash inflow will be received in 1 year's time. Whereas according to this question, the first cash inflow is going to be received at 0.0. So it means it's an annuity project, it's an advanced annuity project, so we have to multiply it with 1 plus R, which is 1 plus 0.1. So 11,000 into 5 years annuity factor into 1.1 for the advanced annuity. So may I know what's the answer? Four five eight seven one. And then we'll just subtract 32,000 from it. So it will be $13,871. So anyone who has come up with a different answer will get full marks for the creativity, but no marks for the correct answer. Sorry. So should we move forward? Sir, do it on the first method. Okay. Okay, the first method was, since this project will start from 0.0, then there will be 1, 2, 3, and then 4. So 1, 2, 3, 4, 5, 5 years, 5 payments. So it means it will end at year 4. So what we need to do is just pick an annuity factor for year 4, which will be 3.170. 3.170 multiplied with 11,000. But this 3.170 is for year 1 to year 4. And we are also going to receive something at 0.0, so we have to add 1. So this is for 4 years, and this is for year 0. So in total, there will be 5 years. So 11,000 should be multiplied with 4.170. So it's 45870. 45870 minus 32,000. 13870, approximately the same answer. So I hope it's clear. Abdullah, is it clear? Okay, let's move forward. So I hope now you people have got you've got the difference between an ordinary annuity which starts from year 1 and an advanced annuity which starts from year 0. So make sure in the exam question you people are able to identify whether a project is an advanced annuity project or is it an ordinary annuity project. So, like, 5 minutes break, please. Okay, let's take a 5 minutes break. So let's take a 5 minutes break and come back after 5 minutes. Yeah, Uzair, you're absolutely right. Arrears means payment at the end of every year. Well, Rasha, we have done basic calculation for NPV. We are done with the advance annuity. We're done. We are just about to start the delayed annuity now. Abu Bakr, yes, I will guide you as the session progresses. I'll guide you about the theoretical questions and about the multiple choice questions as well. We'll be solving the multiple choice questions as well. And I'll also be sharing my WhatsApp group link with all of you so that you can join that group and we can always have discussion on that group as well. No, Abdullah, I haven't forgot it. We will discuss it later. So let's start again. Now, as we saw, there was an ordinary annuity starting in 1 year's time. There was an advanced annuity starting in from year zero, and we can also have delayed annuity, which may start beyond year one. That is, it may start from year two and onwards. So, how to calculate the present value for a project that will start from year two onwards? So if you look at this example, a company is considering to invest $30,000 in a 6 years project. It's a key. Remember, this project has a 6 years life. So it means the last payment that will be received will be at the end of the 6th year. So no payment is going to be received after year 6. The project is expected to generate cash inflows of 14,000 per year, but more importantly, it is starting from year 3. So it means that we are not going to receive anything at the end of year 1, and we are not going to receive anything at the end of year 2. So the very first payment that we will be receiving will be from the end of year 3. The cost of capital is 10%. So we have a tabular approach. Let's first solve it using the tabular approach, and then we'll move towards the formula approach, and we'll reconcile whether the answers match or not. So since it starts from year 3, so I haven't written year 1 and year 2. There's no point of writing it if we don't have any cash flow at those 2 years. So from year 3 onwards, and it will end at the 6th year. So 10%. So we have to pick the discount factor for year 3, which is 0.751, then 0.683, then 0.621, and 0.654. So if you can just quickly tell me the answers. 10514. Thank you. What's next? On your screens, you people have the link to join my WhatsApp group. Okay, next is 9562 8694. 7896. Okay, thank you. And now may I have the sum of all these cash flows? 36,666. Too many sixes. Okay, so it's 6666. Okay, so this is the tabular approach, but definitely it's a very linear approach, so we can't use this approach in an exam. So let's use this formula to solve this question. According to this formula, we need to pick up the annuity, which is 14,000, multiplied with the annuity factor. Now, which annuity factor? Here you go. Annuity factor for the number of payments. So we need to find out the number of payments that we're going to receive throughout the life of the project. So since it's a 6-year project, and we were told that the first payment will be received at the end of year 3. So out of 6 years, we won't be getting anything for the first 2 years. That is, we won't be getting 2 payments. So out of 6 payments, we won't be getting 2 payments. That means we will be getting 4 payments. So since we'll be getting 4 payments, so we have to take annuity factor for 4 years and not 6 years. Remember this. The annuity factor should be for the number of payments. So there are 4 payments in this project. So we'll go back to the annuity factor table and we'll see what annuity factor do we have for year 4 at 10%. This is 10%. And for year 4, it's 3.170. So 3.170. So this is the annuity factor. And then it says that we need to multiply it with the discount factor. Now, which discount factor? The discount factor for the number of years delayed beyond year one. Now, as you all know, that the ordinary annuity starts from year one, whereas this project is starting from year three. That is, it is starting to generate cash inflows from year three. So the gap between an ordinary annuity and this annuity is 2 years. Usually it starts from year one, and here it is starting from year three. So we can say there's a delay of 2 years. So the discount factor should be equal to the number of years delayed. So if you can just go back to discount factor table, go to the 10% column and look at the discount factor at year two. May I know what's the discount factor for year two at 10%? It's the annuity factor, Iram. Remember, we won't use two annuity factors. We have already used the annuity factor. Now we are going to use the discount factor and not the annuity factor. It's 0.826. Abdullah, it's the annuity factor. Remember, we have to use discount factor and not the annuity factor. And everybody should understand the difference between annuity factor and discount factor. When I say we have to use discount factor, make sure that you're using discount factors. And when annuity factor is required, make sure that you're using annuity factor. So it's annuity factor 0.826. So just multiply 14,000 by 3.17 and then multiply it with 0.826. Okay, it's 36657, approximately the same. It's just because of the rounding off thing. Minus 30,000, so it will be 6657. A $9 difference because of rounding off. So this is one of the ways we can solve this question. Is it clear to everyone? Okay, now just follow. I'm just going to tell you another way of solving this question, and probably you will feel it more simple approach. In the 10% column, go to the 6th year annuity factor. Since it's a 6 years project, if we pick this factor, remember it will include all the discount factors from year 1 to year 6. So if we take this annuity factor and multiply it with the cash inflows, it means we have assumed that we are going to receive something at the end of year 1 and something at the end of year 2 as well. But according to the question, it's not the case. So what we need to do is, just from this figure, subtract a 2 years annuity factor. So from a 6 years annuity factor, if we deduct a 2 years annuity factor, we'll be left with the sum of the discount factors for the rest of the 4 years. That is year 3, year 4, year 5, and year 6. So 4.355 minus 2 years annuity factor. May I know what will be the answer? 2.619. So instead of using any other approach, we can just take this as our annuity factor and multiply it with the cash inflows that we were receiving after every year. What were the cash flows? 14,000. So if we multiply 14,000 by 2.619, we will almost get the same answer. 14,000 into 2.619, 36,666. So we can also use this approach as well. Now it's totally up to you people which approach you use. Ali, as far as the decimal places are concerned, usually we use up to 2 decimal places. But in certain cases, like in risk management, we use up to 4 decimal places as well. But usually we use figures up to 2 decimal places. Yeah, Iram, you're absolutely right. It's the annuity factor for the last 4 years for the project. So any questions? Which method is more preferable in the exam? Nakib, it's totally up to you. It's totally up to the students. So which method they use, as far as the answers are same, it does not make any difference which method you use. Any questions, or should I move forward? Okay. Go ahead and solve this question. Don't use a tabular approach. It will take some time. Use it at home. Just solve this question using either of the rest of the two methods. So Keen, I didn't get your question. Answers very useful. Okay, yeah, answers are different, but the variation isn't that big that you may not be able to pick up the right option. If you have an MCQ in the question in the exams, your answer will be very close to one of the 4 options, and you'll have to choose that. Unable to join the WhatsApp group. Why is that so? Just Adil, you just look at your end, because I can see students joining the group, so it means there's no problem at my end. Maybe there's some problem at your end. Okay, Khalid, you're also facing the same problem. Maybe while copying the link, you may be copying the space as well. Just look at, make sure that you're not adding any space in the link. Okay, it's a 8 years project. So the NVT 17,000. It's an 8 years project, but we don't need to pick up 8 years NVT factor under this approach. We just need to find out the number of payments for this project. So in an 8 years project, if you're not going to receive anything for the first 3 years, it means you're not going to receive 3 payments out of 8 payments. So out of 8 payments, If we are not receiving 3 payments, it means we are receiving the other 5 payments. So the annuity factor used should be for 5 years. So can I have annuity factor at 12% for 5 years? 3.605. Adam, I hope you have picked up for the fifth year as well. For the fifth year. Okay. 17,000 into 3.605. Now, multiplied with the years, with the discount factor for the years delayed. So since in a normal annuity, we start receiving a cash inflow from year 1. Here we are receiving it from year 4. So how many years delay is there? 3 years delay, yeah. So we have to pick 3 years discount factor. So can I have the 3 years discount factor at 12%? 0.712. Okay. So what's the answer of these 3 values? 43635. Okay. The amount of investment is $60,000. So if the company goes ahead with this project, it will be having a negative NPV of 1637365, right? Okay, let's move forward to the next example. Of course, Ahmad, if I won't talk, how will you listen to something? How will you hear it? Okay. Annuity, which is 14,000. The number of payments, if you look at this, it's not a 5 years project. It says that the cash inflows of 14,000 per year for 5 years. So it has clearly told us how many payments are we going to receive. So we are going to receive 5 payments. So can I have an annuity factor for 5 years? 3.791. Okay. Then we need a discount factor. So it is starting from year 3. So we need a discount factor for year 2. 0.826. Yeah. So what's the present value? 43839. 43839. 839, and the investment is 50,000. So there will be a negative NPV of $6,161, right? I hope it's clear now. Okay, let's move forward. So let's move towards perpetuity. Well, a perpetuity is an annuity that lasts forever. For example, if you buy uh, if you buy shares of a company, so you will be receiving dividends for an indefinite period of time. You will be receiving dividends till you hold the share. So the number of dividends that you are going to receive will be indefinite. So in case you are receiving cash inflows for indefinite period of time, such annuity is called perpetuity. Fahim, whether it's ordinary shares or it's irredeemable preference shares, in both cases, investors received dividends for indefinite period of time. So in that's the case of perpetuity. Now, how do we calculate present value for a perpetuity? Remember present value. I told you that present value for any given cash inflow is actually the maximum that a company should be willing to invest for a particular project. So whenever we are supposed to calculate present value for any cash inflow, we are actually calculating the maximum that one should invest for such cash flow. Now, if you look at this example, example one, a company is expecting to receive $6,000 per year, and it's an ordinary annuity starting in 1 year's time. But excuse me, but you will be receiving it in perpetuity, means forever, for indefinite period of time. If the required investment is $50,000 and the cost of capital is 10%, what is the net present value of the project? Now, since this company is going to receive $6,000 forever, now it wants to consider how much should be invested for these $6,000. Now, remember, the company needs to generate 10% return every year. So it will not invest any amount for this project which will result in a lower return than 10%. Now, if this company is receiving 6,000 every year, we need to find out what amount should this company invest at max to be sure that it generates at least 10% return. So we don't know that amount. So we'll just suppose that it's X amount. And this company wants this X amount to be such that when it takes 10% of this amount, it equals $6,000. If this happens, it means this company will generate 10%. So we just need to find out 6,000 is 10% of which amount. So just divide it by 10% and we will come to know what should the maximum value be. So can I have the value of X? Yep, $60,000. Yeah, excellent. So it means that if this company invests $60,000 in this project and takes 10% of the 60,000, which will be equal to 6,000, it means it will be generating 10% per annum. So investing 60,000 and then getting 6,000 in return means that this company is generating 10%. So it will not invest any amount above $60,000 for this project. But fortunately, the required investment is less than 60,000. It's just $50,000 for the same 6,000. So this is the present value, 60,000, and this is the required investment, which is 10,000 lower than the required, lower than 60,000. Therefore, the company will have a positive NPV of $10,000. So the very simple formula for calculating present value of annuity or present value of perpetuity will be very simple. Annuity, that is 6,000, divided by discount rate, which was 10%. Here we go, $60,000. That's it. So these $60,000 are actually the maximum that this company should be investing against the $6,000 that it will be receiving every year for forever. I hope it's clear. Okay, whatever the case is in case of perpetuity, the first step will be to divide annuity by the discount rate. In any case, if it's a perpetuity project, all you have to do is to divide the annuity by your discount rate. Once you have done this, then you have to look at whether it's ordinary annuity. If it's ordinary annuity, do nothing. You've got the present value. But if it's advanced annuity, then you'll have to do the same thing which we did in case of advanced annuity. So in case of advanced perpetuity, you just need to multiply this fraction by 1 plus r. Just multiply it by 1 plus r. Okay. Just quickly solve the second example. It's for the advanced annuity. So the first step will be 8,000 divided by 0.08. This will be the first step. And since it's advanced annuity, first one due now, we have to multiply it with 1.08 as well. So it will be equal to 108,000. And then we need to subtract the initial investment, 60,000. So it's $48,000 NPV. So is it clear? Yeah, Ali, it's for delayed perpetuity. The next example is the same. So now let's move towards the delayed perpetuity example. Again, as I told you that whatever the case will be, the first step in perpetuity project will always be to divide annuity or perpetuity by the discount rate. So 9,000 per year divided by 0.08. This is the very first step that should be done every time. But since it's a delayed annuity, so we have to multiply it with the discount factor as we did in delayed annuity case. In this question, it is starting from year 4. So for how many years it has been delayed? May I know the number of years delayed? Yes, it's 3 years. Because it was supposed to start from year 1, but it is starting from year 4. So there is a 3 years delay. So at 8%, may I know the third year's discount factor? Iram, again, you are picking up the annuity factor. We need a discount factor for year 3. 0.794, yeah, it's 0.794. So because of the delay, we are multiplying it with the discount factor. So what's the answer? 89306, and the initial investment is 40,000. So the net present value will be 49306. It's 89235. It won't make that difference. It's almost the same value, 89305, or it's 89325. That not a big difference. So that was perpetuity. So we're done with the perpetuity starting in 1 year's time. That is ordinary perpetuity. We are done with the advanced perpetuity and then the delayed perpetuity. In case the WhatsApp is not working, you people can text me on WhatsApp using this number 00923212604033. Do I really need to repeat the mobile number? It's right at the top of the screen. Here is. And we also need your honest feedback as well. Just give us your honest feedback. Okay, let's move forward to our last topic of the day, that is the internal rate of return. For this particular part, I would like attention from your side. It's a bit technical. If you just look at this example, there's a project which has two different net present values at two different discount rates. So at a 10% discount rate, when we discounted this project at 10%, we got a positive NPV of 2,000. So what does this tell us? This tells us that we are earning more than 10%, so we should accept this project, right? If we require a 10% rate of return, then it's a very good project because it is giving us more than 10%, right? But if the same project is discounted using 15% discount rate, it gives us a negative NPV of 500, which means that we should not accept this project if we require a 15% return from the project, because at 15% discount rate, it is giving us a negative NPV. So remember the 10% and the 15%, none of them are the required returns of the company. They are just being used, and they're not the required return, because you can't have two returns. A company will have only one required rate of return. So they are just two assumed rates. We've just put 10% as a discount rate, and we've seen whether we are earning more than 10% or less than 10%. So according to this project's NPV, this project is giving us a higher return than 10%. But at the same time, when we discounted this project at 15%, we've got negative NPV, which tells us that this project is giving us a lesser return than 15%. So the return of this project is somewhere between 10 and 15%. So we can say it's more than 10%, but less than 15%. But what actually the return is, we don't know. Now, if our cost of capital is 10%, we will accept this project because this is giving us more than 10%. But if our cost of capital, that is the required rate of return, is 15%, we will reject this project. Now, what if the cost of capital is in between 10 and 15%? Will we be able to decide with this information, with the help of this information? No. If our required return is 10% or less, we should go for this project. If our required return is 15% or more than 15%, we'll reject this project. But if it's between 10 to 15%, we can't decide with the help of this information because we don't know what actually we are earning and what actually we want to earn. So for this, we must first find out the IRR of this project, that is the internal rate of return of this project. The internal rate of return of this project is the rate of discount rate at which NPV will be 0, which means we need to find out at what maximum discount rate the NPV will be 0. Say, for example, just for the sake of example, if we assume that at 12% the NPV is 0 for this project. If we are able to find out this 12% at which NPV is 0, what is going to do to us? As we know that this project has 0 NPV at 12%, which means at 12% cost of capital, this project will not save anything for the company. So the company should not accept this project if it needs a return more than 12%. Say, for example, if the cost of capital of the company is 14%, this company should not accept this project because it will not save anything at 12%, and at 14% it will be at loss even. So if we are able to find out the rate at which NPV will be 0, it will help us to decide whether a project should be accepted or rejected. So this rate is called IRR. So now we have to find out this rate of return at which NPV will be 0. Is this clear? Okay, that the problem is how to find out a rate at which NPV will be 0. Since according to this question, at 10% the NPV is positive, at 15% it will be negative. So we can clearly see a relationship between the discount rate and NPV. When we increased our discount rate from 10 to 15%, we saw a fall in the NPV equal to 2,500 because it was 2,000 positive and now it is 500 negative, which means there is a difference of $2,500. So if we try to establish a relationship between NPV and the discount rate in this case, it is a total change in the NPV is of 2500. And I hope people have got this 2500 change from 2000 positive to 500 negative. It's a 2500 change. So there's a $2,500 change in the NPV because of the 5 percentage point change in the IRR. So a 5 percentage point change in IRR has resulted in a total change of $2,500 in NPV. So per percentage point change will be equal to, may I know the per percentage point change in NPV? If 5% has resulted in 2,500 change, then what change it will be, what change will be there if we change it by only 1 percentage point? 500 divided by 500. So every 1 percentage point in this case will change the NPV by $500. Now, if I tell you that we are standing at 2000 positive NPV and we want to reach to 0 NPV, and we know that every 1 percentage point change is going to bring $500 change in NPV, and it's the inverse relationship. So if we want to reduce the NPV, we have to increase the discount rate. Here we have 10% cost of capital and we have a positive NPV of 2000. Now, if we want to convert this 2000 positive into 0 NPV, definitely we have to increase our discount rate. And remember, every 1 percentage point is bringing 500 change in the NPV. So if we increase our discount rate, by 1% only, the NPV will be equal to what? Just quickly, 1500, right? And then if we increase it further 1%, it will be reduced to 1000. If we increase a further 1%, it will be equal to 500. And if we increase it a further 1%, it will be equal to 0. So 10 plus 1 plus 1 plus 1 plus 1 will be 14%. So it means at 14% cost of capital or discount rate, the NPV will be 0. So we have to increase our current discount rate of 10% by 4 percentage points. Now, how we can calculate this 4 percentage points is very simple. 2000 is what we need to change, and each change is equal to 500. So if we want to change our discount rate, we have to change it by 4 percentage points. 2000 divided by 4. And at the moment it's 10. So if we increase by 4, it will be 14%. So at 14% rate, the NPV will be 0, and this is our IRR. We can calculate the same value of 14% using this formula. IRR is equal to A% plus capital A divided by A minus B into B% minus A%. Whereas A% is the lower rate. Out of these two rates, A% will be the lower rate, which is 10. This is the lower rate. A is the positive NPV, which is 2000. A again, it's 2000 minus, and then minus B is the negative NPV, which is 500 negative, multiplied by the higher rate, which is 15%, minus the lower rate, which is 10%. Now, if you just can quickly solve this equation and tell me what's the answer. 14%, yeah, right? So from now onwards, we'll be using this formula for calculating IRR. All this stuff was to explain what IRR is all about. So at 14%, this project will save nothing for the company. So the company will not accept this project if it has a higher cost of capital than 14%. But in case the company's cost of capital is less than 14%, it will accept this project. So at the moment, if you say, sir, what should we be doing at 14%? If the project's IRR is 14%, what should we be doing? We cannot decide. We cannot decide by looking at the IRR only. We must compare the IRR with the cost of capital or the required return of the company. IRR is simply telling you that the project will have no savings at 14% return, at 14% discount rate. So at 14%, you won't save anything. Now just compare this 14% with your cost of capital. So the rule will be accept the project where IRR is greater than cost of capital. So remember, alone IRR will never ever help you decide. You must compare the IRR of the project with the required return or the cost of capital of the company, and only accept the project if your IRR, that is the rate at which the project is generating returns, is higher than what is required by the company. Is it clear? I want everybody to say yes if it's clear, so that I know that maximum people have understood what IRR is. Saad, IRR is telling us at what rate the NPV will be zero. So if we know that at 14% NPV will be zero, so we will not accept this project if our cost of capital is more than 14%, because at more than 14%, the NPV will be negative. So if the cost of capital is more than 14%, it means we have to pay to our shareholders more than what we are earning from the project. So IRR tells us what we are earning from the project, and cost of capital tells us what we are paying to our investors. So if the cost of capital is higher than the IRR, it means we have to pay more, whereas we are earning less. So we should not accept the project. Okay, Fahim, if cost of capital is equal to IRR, should we accept the project? Well, don't expect that examiner will give you the situation where cost of capital is equal to IRR, and then he will still ask you to decide whether to accept or reject, because this will be purely on the management, whether they are good enough, or whether they're happy with this return. But with objective answer, I would say the company will be indifferent, because if the cost of capital is equal to IRR, it means that the company will save nothing, but at least it will be able to satisfy its investors. So usually the company will look for any other project which has a higher IRR than the cost of capital. But in case the company does not have any other project, even with the cost of capital equal to IRR, the company may go for it so that it can keep its investors satisfied. Okay. Here in this question, what is the cost of capital? Sakeen, we haven't taken any cost of capital. We were just learning how to calculate the IRR. Definitely in the exam question, if we are to decide whether to go for a project, they will give us the cost of capital. So here we don't have any cost of capital. We just calculated the IRR. So I think it's enough for today. I want all of you to go through what we have studied today at home, and I would also like you to go and watch my videos on Vimeo. If you go to vimeo.com/ACCA Pakistan, there you will find my F9 videos for the previous sessions, and if you can just go and watch day 1 and day 2 of investment appraisal, it will very be helpful. And tomorrow we will be solving the full length questions which you will be seeing in your section C of the syllabus. So I hope today's session was good. It was helpful for all of you. And it's goodbye. Have a good day. Thank you very much for the compliments. Bye bye.